Good evening, students. Welcome back to our second day session on general insurance practice. In our last class, we had discussed the environment of general insurance and the major documents that are being utilized, documents and forms utilized in the insurance sector. Today we go to the main products of insurance, all the policies and products that are available. Our first session half of the session will be on fire and marine insurance, and subsequently we will deal with motor, accident and liability. When we look at fire insurance, we have to remember that this is because of the Insurance Act, where departments in general insurance are divided into fire, marine and miscellaneous. Now in fire insurance, as the name connotes, it is mainly fire that is covered. So the original insurance was for fire insurance only with lightning. Subsequently, due to circumstances, the insurance industry combined a number of other perils and called it the standard fire special perils policy. So the name fire came because the original policy was fire. All other perils that were required had to be taken on add-ons at extra premium. So we look at fire insurance. The main features of fire insurance, it is location-based. So what is important in fire insurance? The address of the property which we wish to insure has to be clearly mentioned, so that at any point of time, anyone visiting can check and verify that this is the address of the property insured. So location-based is the most important factor of fire insurance. Now the properties that are insured can be divided into fixed assets and rolling assets. In the fixed assets, we normally use very short terms called BMA. So if you look at, B stands for buildings. So the building values of the building of installed can be insured. M stands for plant and machinery. So in factories we will come across this. We are insuring factories. We could have a building, we could have plant and machinery. A is for other assets, and the most common short term we use is furniture, fixtures, fittings, FFF. So other assets could be furniture, fixtures. It could be other properties like computers and air conditioners and other assets which are normally not part of the business. For example, if you are looking at an office, you would have building and you have other assets like computers, equipments, furniture, fixtures, fittings and other things, stationaries, etc. So these are fixed assets. Now why do we specify? You will know, because of certain factors in fire insurance. These are long-term assets. They will remain for a long period of time. So valuations will change over a period of time. The rolling assets, the most common is stocks. So when we say stocks are first raw materials. Then while they are being processed, they are known as stock in process. And finally, the ready-made product or the finished goods. So three types of stocks could be considered. Normally what we would insure, raw materials and finished goods are separate. Stock in process, because that is as it is going through the process at that material moment of time. So it is a small component of the total value of the stocks. So the two assets that we have to remember are our fixed assets and rolling assets. Now what do we cover? So when we look at now the fire policy, what do we see? It is a specified perils policy, which means we are not covering everything, but we are covering direct losses caused by certain perils. The social perils, like fire, the most important. Riot and strike. So riot and strike are social perils. Malicious damage, which in short we call RSMD. Then we have our natural perils, which is lightning, storm, tempest, flood, inundation. So storm, tempest, flood, inundation, a short form that we use in insurance called STFI. So this includes cyclones, this includes hurricanes, this includes typhoons. The third is landslide and subsidence. So these are what we call natural perils. The other types of perils are explosion and implosion. Now here a very important factor we have to remember, explosion and implosion of all types of equipment other than boilers for commercial purposes. So boilers in factory which are used in factories and pressure vessels are not part of this cover. For that, explosion has to be taken separately. Bursting and overflowing of water tanks and pipes, missile testing, aircraft or any aerial device dropped from above, bushfires, that is small little grass that is growing in a property, and if it catches fire. So those staying in open areas in Madhya Pradesh and grasslands will know in summer months sometimes the dry grass catches fire from the heat. So these are types of bushfires. Impact damaged by outside vehicles, animals, outsiders' property causing an impact or damage to the property insured. So these are the perils, fire plus 11 perils that are forming part of the fire insurance policy, and they are taken for the purpose of the location-based address and the values for which we have taken insurance. Every insurance policy has exclusions because insurance companies look to see at a large risk to be insured for major losses. So there are certain exclusions that are standard to every policy. In fire insurance, the first condition we call is exclusion comes as an excess or deductible. From every loss, some amount will not be payable. That is 5% of the claim amount with a minimum of 25,000, 10,000 depending on the type of property. Then war and nuclear risks. Nuclear risks are uninsurable. So worldwide we do not cover nuclear risks. War is a cover that occurs off land, not on land. So when you move across countries, the possibility of war. So war is not a location-based risk. Earthquake and terrorism are also not covered, but these can be covered at extra premium. Pollution and contamination. So pollution losses are not covered. Contamination because of something getting destroyed or damaged and causing contamination in the area is not covered because these will fall under liability. But if the property is damaged as a result of that, it would be covered. Valuables and explosives. Now valuables are covered for a small amount of 10,000, that's like works of arts. But explosives requires prior permission because they fall under certain regulations of the Explosive Act. So explosives will result in a greater risk. So these valuables and explosives need to be informed if you want specific cover for full value. Fire insurance is about accidental fires that start. We do not cover electrical fires. When we say do not cover electrical fires means because of some short circuiting, a material is damaged, is not covered. But the resultant fire, if a flame starts thereafter, all the property that is destroyed by the flame would be covered except the item for which where the short circuit originated. Similarly, in cold storages, because of some damage somewhere, the refrigeration system stops functioning and so the temperature rises and the items within the cold storage are destroyed. This is not covered. Similarly, spoilage, risk because of delay or because property is damaged, so material line, these are not covered. A policy, as we had seen earlier in our documents, we had seen the parts of a policy. So when we look at it now, what we have seen as the policy word coverage, the perils would be treated as operative clause. Exclusions are the exceptions, and then we come to the conditions. Every insurance policy has certain conditions. The common conditions, first is utmost good faith. That is, giving all details. So misdescription on the part of a customer or misinformation on the part of a customer makes the contract void. So if it is important, it will be a void contract. If it is just a mistake, it could be considered, but it will be voidable. So the party, what insurance says, voidable contract, where the party who is suffering as a result of the consequences of a mistake can avoid the insurance. Change in the risk. Now this is a very important factor, because when we insure, we look at the risk from the point of view of what is covered, what is the commonality of the cover. So for example, if I have a premises which I am using as an office and I subsequently convert into a godown or storage place, the risk has become greater. This is an important change and it has to be informed to the insurance company, otherwise the policy will cease. Cancellation. Every contract has a condition of cancellation, that is, either party can cancel at any point of time. Cancellation on the part of the insurance company will result in a proportionate return of premium. Cancellation on the part of the customer or the insured will result in a short period rate of premium being charged and refund thereafter allowed. Fraud. If any fraud is observed in a claim or fraudulent information provided, then this contract comes to an end. Insurance company is not liable for anything once a fraud is detected. The condition of average. Another term we use in insurance, underinsurance. The property has been insured for a lesser value than it should have been, and so the customer has to bear a proportional part of the loss. This is known as the condition of average. If you will see your textbook, you will see the formula where we say the sum insured upon the total value of the property divided by the total value of property, that proportion only of the loss you will get. The next condition is contribution, where more than one policy has been taken for the same property for the same perils and risk. So 2 fire insurance policies for the same property will mean that both policies will share in any loss in the same proportion, that is contribution. Subrogation. Subrogation is the right of the insurance company to recover from somebody who was negligent. For example, if in a residential complex, the neighbor is doing some repairs, and as a result of the repairs, there is damage to your insured property. So there is a fire, and the fire spreads to the adjacent flat which belongs to you. In that case, you have a right to file a case against your neighbor because it was work done there which has caused the damage, in which case they are required, you go to a court of law and claim. But because you have insurance, you claim from the insurance company, in which case the insurance company will recover, will settle your loss, and then will go ahead and claim from your neighbor for causing the loss. So the process of subrogation written in this policy means the process has to start immediately after the loss, so that the right is protected by the right of the insurance company is protected for obtaining legal recourse. Arbitration. Arbitration is used in the policy when the claim amount is in dispute. Insurance company is willing to settle a claim, but for a lesser amount. The customer is not happy, the insured is not happy, they believe that their loss is of different figure. In that case, arbitration comes into the picture. A very important notice that all information about the risk or all communication with regard to the policy or claim must always be in writing. A verbal information should always be followed by a written request. So these are common conditions you will find in every insurance policy, not merely in fire. For this reason, I have gone a little more in detail on these common conditions. Now, the conditions specific to a fire insurance policy. if there has been a fall of the building or a displacement, say there are three blocks connected with each other and one block collapses for apparent whatever reason. It may not be resulting due to any of the perils we have insured. It may just because the building is old. So a part of the building has fallen, which means the rest of the buildings have become weak. So insurance company has to be informed. This is a very important condition. Any change has to be informed to the insurance company. The insurance company can take possession of a damaged property if they so desire, if they feel that the customer is not protecting the risk and ensuring the risk is not, or the loss is not aggravated. The insurance company may take possession of the property till they finally decide about the settlement. The insurance company also has the right to reinstate or replace the property or to pay a rupee value of the property. Automatic reinstatement of sum insured. Now, the minute a loss takes place, the value for insurance is reduced by the amount of the loss. So, the day a loss has taken place, the very next day the value for insurance is reduced by that amount. So, it is a provisional loss. The fire insurance provides for immediate automatic reinstatement back to original sum. An example, a property is insured for 10 crores. A loss of 3 crores is reported. So, immediately after the loss, the balance sum insured under the policy will stand reduced to 7 crores, that is 10 minus 3. But in fire insurance, the sum insured is immediately reinstated to 10 crores. How is it done? The insurance company at the time of settlement of the claim will charge a premium for the 3 crores or whatever is the loss assessed for the period from the date of loss till the expiry of the policy in a pro rata or proportionate basis and reinstate the sum insured. So in the event of a subsequent loss, the insured has the value as original available to him. So we have just seen the main fire policy, that is the operative clause. We have seen the exclusions, we have seen the conditions. We now see what add-ons can be offered in the fire policy. There is a minimum cover to cover architect's fees and debris removal, because immediately after fire, any of the perils that cause loss we have seen, there will be a lot of debris which has to be removed. We cannot just throw it on the roadside. It has to be taken to a particular dumping yard. So the cost of cleaning and removing is also payable to some extent. An additional cover is available if we want more than that. So an architect's fees is payable up to 3% of the claim amount in a normal policy. If you require more than that, that is equivalent to 7.5% of the sum insured, an add-on premium is taken. Similarly, for debris removal, the coverage is free inbuilt cover of 1% of claim amount. The client can take an add-on for higher amount. Escalation. What does escalation mean? As you know, inflation and costs are rising every year. So a property that is insured for X value today, tomorrow to repair it would cost more than what it is today because of the cost increase for material. So escalation is an add-on cover available. Loss of rent. A landlord who has given property on rent, if the property is damaged in a fire, for the period till he brings the property up to normal again, he is losing his rent. So he can insure that. Earthquake, terrorism, impact damage. These are coverages. Impact damage of our own vehicles. So insured's own vehicles causing damage can be covered by this add-on. Spontaneous combustion is required and taken for properties which have an inherent built-in chemical reaction which results in the property getting burnt. For example, coal. It can get overheated and burn within itself without creating a flame. Similarly, oil cakes. So spontaneous combustion is taken for such stock which are subject to being burnt within themselves. Cold storage, we saw that temperature reduction, because of change in temperature, stocks lying in refrigerated systems would be not payable, so here is an add-on available for that. Temporary removal of stocks. Now, where we have seen fire is a location-based policy, so it covers only at that location, but temporary stocks may be sent for processing at another location, so we could cover the stocks for that at that particular location by an add-on. Forest fires taken where in forest areas with properties being insured near forest areas, they are subject to certain conditions, and there are certain businesses where startup expenses would be required in the event of a loss to restart. There are additional costs to start up are required, so this could be taken there. So we have seen now the add-ons that could be available under a fire policy. Now we come to the types of policy that we have. A normal fire policy, is by default a depreciated value policy, or what we call market value. When we say market value, we say the new cost of that replacement less depreciation for usage. So number of years for which it has been used, that is the depreciated value. The next is, this is for fixed items. Reinstatement value can be taken for our fixed assets, the BMA. That is, we will not apply depreciation on the value. This is known as an RIV policy. In stocks, because stocks are subject to fluctuation in value depending on demand and supply, instead of having a fixed sum assured, we can go for a declaration policy, because during the course of the year, the value of stocks lying in storage may differ greatly across the months. So a monthly declaration is given, a provisional sum insured is decided, and thereafter a monthly declaration of stocks lying in the previous month are informed to the insurance company. It's averaged out, and this is our declaration policy. A floater policy is taken for stocks which are stored in a number of locations where the customer cannot at any point of time give us what value is lying at each location. So they list out all the locations, and they just give us one sum assured that these are the locations within which this total value of stocks may be lying. So this is our basic fire policy for the purpose of your understanding of policy for licentiate. Our declaration policy, we now look at another type of policy called industrial all risk, normally given for policies where the property is more than 50 crores at any location. It is similar to a fire policy that includes all the fire perils, but it covers an additional cover, burglary. The other section is machinery breakdown. We will be seeing these individual policies in subsequent lectures, so we will not go into that in detail, but just to give you an idea, machinery breakdown. Then there could be business interruption because of fire, that is an impact on the business expenses and profits of the company because of a fire. So business interruption for fire, and an optional cover of business interruption for machinery breakdown. So the only optional cover is for machinery breakdown. Otherwise, fire for all the properties, machinery breakdown, as well as electronic equipments and fire business interruption is covered. One additional policy which we will look at, and that is called fire loss of profits. As we see here, we have business interruption for fire. This policy is covering the impact of a fire loss on the profit of a company, on the gross profit of a company. So it essentially covers what we call fixed cost or fixed charges that are incurred, which will be impacted, and the profit gets reduced because of this peril. So business interruption. With that, we just finish our fire policy. We will now look at marine insurance. Now marine, the very word marine brings to your mind something related to water. So what we find in marine insurance It is governed by a law called the Marine Insurance Act 1968. Now, what is vital about this? The Marine Insurance Act. What is vital? Under this act, we can divide marine insurance into insurance of cargo, insurance of hull. Hull means ships. Ships while sailing, ships while being built, ships while being destroyed can all be covered under a marine hull insurance. So various types of hull policies are available. The third is the freight. If the shipping company or the ship owner is taking cargo where the freight would be paid only on delivery to the customer, that also can be insured under marine insurance. It is normally given as a freight cover under the hull policy. Now, one very important factor we have to remember, and that is with relate to insurable interest in marine. We have been taught in our principles of insurance that marine insurance insurable interest is required at the time of loss. We need not bother about whose right has to take insurance when we take insurance, but when the loss occurs, who is the insured who is entitled to compensation or reimbursement of loss. So the most important factor for that, to get an understanding, the insurable interest in cargo insurance is on the contract of sale. Contract of sale, the type of sale that we have, a cargo owner, a buyer has, a seller and buyer have entered into decides the insurable interest. So the first type of contract, and these are known as Incoterms, is Ex Works. Short form you have see on your screen, EXW. Ex Works means that the buyer will take delivery from the seller's manufacturing site, warehouse, and the buyer therefore will take insurance and arrange. Seller does not need to take the cargo insurance. Free on board. Now here the seller has taken an added responsibility to pack up the cargo and deliver it onto the ship. So we'll arrange for the transit from, the seller arranges for the transit from the warehouse to the port whilst lying in the port and until it is loaded on the ship. That is known as FOB or free on board. So here there will be two insurances, one taken by seller from his warehouse to the ship, because the seller is responsible. If any loss takes place in this course, the seller will have to will suffer the loss. The buyer takes thereafter, because that's the buyer's responsibility. Cost and freight, C&F or CFR are the terms used. Here too, the seller's responsibility is only up to FOB point. So seller, there will be two separate insurances, seller up to FOB point and buyer from FOB point unto final destination. CIF, cost insurance freight. Here, the buyer has entered into the contract with the seller to arrange for insurance up to the point where the buyer requires. So CIF decides, here the insurance has to be taken by the seller and thereafter it will transfer automatically to the buyer in the course of the responsibility changing. These are very important aspects to remember for insurable interest in marine cargo. Most of you will be coming across marine cargo insurance, so some awareness of the insurance is necessary. The policy wordings. There are two types of policy wordings. If we are dealing with export-import, it is called Institute Cargo Clauses or ICC. Very important, Institute stands for the Institute of London Underwriters. So these policy wordings are international. Their interpretation and understanding is common throughout the world. 80% of the world follows the ICC clauses. So when we talk of ICC, a customer in Beijing or a customer in Brazil or in London or in Africa will immediately understand what we mean. So the contract is very clear. So we use, in export-import, we use the cargo clauses called ICC. For local transits, that is within our own country, we have clauses which were defined and drafted by the Tariff Advisory Committee, and these are known as Inland Transit Clauses or ITC. Very importantly, when we talk of export-import trade, we also include within that insurance of institute cargo clauses the local transport. So ICC clause can be used if I'm exporting from Surat. A cargo is coming to Mumbai port from Surat, and then from Mumbai port it is going to New York. I can take an ICC clause covering road transit from Surat to Mumbai and thereafter from Mumbai to New York by sea. It will still be available as a continuation cover. But if I am insuring from Mumbai to Kolkata, then it will be a local transit and it will be Mumbai to Kolkata by road or rail, ITC. So marine cargo insurance, there are the types of policy. The most important is the specific policy. So every cargo, as and when it goes, I can approach the insurance company, ask for insurance for the particular cargo from which place to which place. I can ask for the cover and insurance will be given to me for that cargo for whichever destination is required. So a single policy for one single consignment. But if I am a businessman, an exporter who is dealing with a number of clients across the world and on an average day around 50 or more cargo is being shipped to all across the world, then it would be very difficult, physically difficult for me to keep on sending a person, go and get this insurance for this cargo, go and get for this. So 50 persons will be required rushing to the insurance company to take insurance. Why take insurance? Because insurance has to be taken before the cargo is shipped. So instead of that, I go for what is known as an open policy or open cover. Now open policy means, when the minute I use the word policy, means it's a legally enforceable document. But when I say an open cover, it is an agreement. So as and when I am sending cargo, I have entered into an agreement, I have kept a deposit with the insurance company, and I will be declaring the cargo the date before it is to leave, and the insurance company will acknowledge and accept it up to the amount that I have kept in deposit. So each time I send a cargo, my deposit will be deducted. I can send along with my statement an additional premium so that there is always sufficient premium to pay for subsequent transits. So an open cover and open policy, it means an open up to the sum assured that we have decided or up to a date on which we have decided. So what in effect is open policies, we will be our customer is declaring the cargo as it goes. Every 15 days, he will send a list of all cargo went the previous 15 days, or 1 month as allowed by the insurance company. So an open policy will just have the broad outlines, and on that basis, the insurance company will be giving the cover. The third type of policy is for imports, where custom duty may be applied on the cargo after it reaches the country. So duty insurance is normally taken for imported cargo to cover the value of duty. Because once the duty is paid, the value of the cargo has gone up, and a standard insurance policy would not then pay for the duty. So duty cover is taken to cover the duty that has been charged, the value of the duty. But it must be taken before the cargo reaches the port, the destination port entry point in the country. The next is increased value. This is a special, what is also called as profit policy. A person imports cargo into a country because they stand to benefit, because the prices differential is great. So they will earn some value. But now if that property is destroyed before they can sell it, they have, or because they have entered into a contract and now they cannot meet that contract, they have lost the value that they would have earned. So for this purpose, an increased value can be taken. Again, this must always be taken in advance. So when we look at our cargo clauses, there are three types of cargo clauses, A, B and C. We will start off with C, which is the minimum cover. This cover is available for cargo being sent by sea. If you see the perils, most of them are resulting because of sea perils, that is stranding, grounding, sinking, capsizing, collision or contact with external objects other than water, discharge of cargo at port of distress. And because I told you that we'd also cover the short period of transit between a location within the country by rail or road, fire or explosion, derailment or overturning, and collusion. So these are the perils. Essentially, this is for cargo sent by sea, the minimum cover. Then there is jettison and general average, salvage charges, collusion liability. These are very important. We have already seen general average. Salvage charges in marine cargo insurance refers to a ship coming to the assistance of another ship claiming for towing it to safety after it brings it to a safe port. So those are called salvage charges. Collision liability is when there has been a collision between two vessels and as a result both are liable for the damage or destruction that may take place. These are standard covers under all marine cargo policies by sea. The ICC-B covers what is covered under sea, and it goes on to cover additional perils of earthquake, volcanic eruption, lightning, washing overboard, entry of sea, river or lake water into the vessel, the craft, the conveyance, and the total loss of a package whilst loading or unloading on board the ship. So whenever there's a reference to vessel or craft, it means only ships and not other type of transportation. So ICC-B is a little wider cover. There are many add-on perils that can be taken with ICC-C or B. If you will see your textbook, you will see some of them. The widest cover is ICC-A. It says it covers all perils other than excluded. So normally everyone talks of it as an all-risk policy. But as I told you earlier, all risk does not mean all risk. It means risk other than excluded. In addition, there is an additional cover, ICC War, because we are talking of crossing oceans, crossing countries. A cargo may be affected by war, and a cargo may be affected by SRCC, strikes, riots, civil commotion. So these are two add-ons available under cargo insurance for export-import trade. These are the standard exclusions that we come across in marine cargo insurance: willful misconduct, deliberate acts of any persons, what we call malicious damage. This is not covered under C and B, it is covered under A. Inherent vice and delay are not covered. Ordinary leakage, loss of weight, volume. You have seen when a cargo is being taken in a truck, you will find that there is a leakage or something is spilling over. So these are called ordinary leakage and they are not payable. So carriers are in financial difficulties and they do not complete the ship. They do not complete the voyage, and as a result, cargo is lost. Insurance company is not liable. We saw war and strikes, riots are not covered. These are covered as add-on perils by taking the add-on cover. And if packing is inadequate, this is also not covered. So here we have seen the main coverage of operative clause of a marine cargo policy, including the exclusions. There is one important element now, and that's a duration cover. By default, Marine insurance is warehouse to warehouse. So we need not ask for warehouse to warehouse. But as I showed you in the contract, it's the contract which will decide whether it is actually warehouse to warehouse or it is terminating earlier or does not even take into force. Once the cargo reaches the final port, it must be delivered to the destination of within 60 days if it is by ship, within 30 days after arrival of the aircraft if it's by air, and for rail or road it has 7 days after the rail wagon enters the city or the truck enters the city of destination of the policy. What we need. Now we look at institute cargo clauses. We look at the inland clauses. Here too you have C, B and A. C is fire and lightning only, and that is only while the cargo is on board the truck. The minute it is unloaded from the truck or the railway wagon, the cover comes to the cover is suspended. ITC-B is what is the normal policy today in the market we call as basic cover. It covers the ICC-C plus breakage of bridges, collision of two vehicles, overturning and derailment. And ITC-A is again and always subject to exclusions. The war is not available for inland cargo because it is within the country, and all the exclusions that we saw in institute cargo clauses appear as exclusions in the ITC clauses too. So these are standard exclusions common to both types of policies. The last now we will look at marine claims again cargo. The types of claims are total loss, which means total destruction of the cargo. The cargo does not exist. It is destroyed, it is burnt, or it is totally unusable. Constructive total loss, the cargo exists, but it cannot be reached. It is too costly to remove it from wherever it has fallen, and so it is a total loss. It is treated as a total loss, but it's called constructive total loss. General average is everybody. Average in marine insurance means loss. So everybody has lost, or whoever has lost or sacrificed to ensure that the voyage is completed successfully is a general average. Everybody shares in that loss. Particular average is partial losses. A salvage loss. Say cargo is to be taken from Mumbai to New York. Unfortunately, that cargo is foodstuffs, and because there has been a delay of bad storms, that foodstuff starts deteriorating before the cargo can reach New York. The ship captain finds that this cargo is damaged at Aden. Instead of carrying it further where it will cause damage to other cargo also, he informs the owner that we are discharging this cargo because it is in bad condition. So the cargo can be disposed of at Aden by means of auction. This is known as salvage loss. To that extent, the insurance company pays the loss of the difference between salvage earned or auctioned off price and the actual value insured. Sue and labor means loss minimization to protect the cargo. A damaged cargo may be repacked or reconstituted to ensure further damage does not take place. Extra charges are survey fees, auction fees and other fees. These are the types of losses you will come across in marine insurance claims. So we have now seen a picture of marine cargo. We will just look one more slide, and that is marine hull. Hull insurance, as I told you, it is insurance of ships. Now when we say insurance of ship, now read the word clause again, institute time clauses. Again a London-based clause terms. So when we insure ships, we use the international standard clauses. Hulls are ships Then we insure the ship for the hull and all the machinery that is there. So the ship, including all machinery, including all stocks that would be required for the voyage or the voyages. It's a specified perils policy. It may be for one single voyage, or it could be for a period of time, like a 12-month period or a 6-month period as decided. So this briefly was our subject of fire and marine insurance.